Welcome back to the channel, everyone. Today I want to start out the video by explaining why it is that the hedge funds are screwed tomorrow. And it's a mixture of the FTDs, or failure to delivers, and the SSR restriction. I then want to explain why, if the hedgies wanted to drop the AMC stock to $10 by now, or $5 by now, they would have done it already. But they can't because the short squeeze is already playing out. Trust me guys, you do not want to miss this video. So stay tuned and let's make some money. But before we dive into the video, I just want to give a massive shout out to the 900 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already, so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, looking at the AMC price chart for today, we can see quite a large drop in the morning, but then a good recovery as the day went on. I personally think this was a very coordinated attack, as it was very sharp and very sudden, off quite low volume, and the entire market is doing something similar. My entire watch list is very red. But guys, fear not, because look what happened when we bottomed out around $42.80. The apes did what they do best and bought the dip all the way back up so far to $46, and if I were to hazard a guess, I think we'll close the day probably fairly flat around $48. But guys, let's dive into the meat and potatoes of today's video. As you can see here from Stonko Tracker, the short sale restriction is currently on with a trigger price of $44.96, which we fell below. So what is a short sale restriction? Well, I've drawn an example here of a stock graph or a stock chart, with time along the bottom and stock price up the side. As you can see, a stock price might move downwards, upwards, downwards, upwards, downwards, and upwards again. When a short sale restriction is in effect, a hedge fund or an institution, or anyone really, can't short the stock when it's on a downtrend or a downtick, only when the stock is moving upwards. So therefore, if us apes are buying the stock, a hedge fund can try and curb our move upwards, but they can't entirely reverse our upward movement and try and push the stock lower, because the short sale restriction will mean that they can't short more shorts, can't short more shares when the stock is going down. But how exactly does this tie into the failure to delivers, and how exactly does it make tomorrow the day that the shorts are screwed? This here is the NYSE threshold securities list, which you've probably all seen before. If you didn't already know, the AMC stock wasn't on this list on the 24th of June, and it was added to this list on the 25th of June, meaning that the failures to deliver had exceeded 2.5 million shares for 5 consecutive days. If we then scroll forward to the 6th of July, which is yesterday, AMC was still on that list. The data for today, the 7th, hasn't yet been released yet, but today will be the 13th day that the stock has been on the NYSE threshold securities list. The SEC rules state that if a stock has been on this list for 13 days, then on the 14th day, all of the failure to delivers must be covered. This is the reported data for failures to deliver. As we can see here, when the AMC stock price shot up to $72, there was 5.4 million failures to deliver. Now, the AMC stock didn't actually make it onto this threshold securities list back then because there was only one singular day when that number exceeded 2.5 million. The fact that the AMC stock has been on this list for 13 days already means there's been at least 2.5 million failures to deliver, and if I would hazard a guess, I would say there's a lot more. Probably even more than 5 million, because when there was 5 million, it wasn't on the list because there was only one day of 5 million. Now, the really key part of how this all ties together is what happens on the 14th day when those hedge funds and when those institutions have to cover those failure to delivers and buy the stock in order to actually deliver it. Well, they can't then go and re-short the stock straight after because of the short sale restriction. Also, I think there is a rule where they have to wait at least 2 days before re-shorting the stock again. I tried to have a dig around and find it, but I couldn't see it. So if any of you apes have seen it, be sure to leave it in the comments below. Here's a post on Reddit that I really liked. If the hedgies had the power to bring us back down to $10, they would have done it already. The fact that they haven't means that they can't. All they have is scare tactics. If we have a look at the AMC chart back in January, when there was a little bit of a squeeze, that squeeze only lasted 1, 2, 3, 4, 5 days, 6, 7, 8, 9, 10 days at a push, whereas this time round it's already lasted multiple weeks. If the hedgies wanted to crush the AMC stock, they would have done it on this day here and brought it back down to $12 or $14, but they can't. Something else that I really enjoyed when looking at this chart on a daily basis, and something that I think is really key and important, is when in doubt, zoom out. Look at the AMC chart here. We can see it went up, came back down again, went back up, and came back down again. The price then held before another squeeze was enacted. If we have a look at the AMC chart now, the price went up, came back down, went back up, came down again. Therefore, we may just trade flat around this kind of $45 to $50 level for another month or two before the next squeeze, which takes us much higher, up over $100, maybe to $150, maybe $200, even higher. Finally for today, guys, here is a very clever post that works out the stock price that will be needed for all of those shorts to be liquidated. So we know there's around 100 million shares that are currently shorted, 100 million shares that are publicly shorted, as it's around 20% of the float. If those 100 million shares were all shorted at $12.77, that would have cost the hedgies $1.27 billion. At the moment, based on the current share price, that would give them an accumulated loss so far of around $4 billion. The post goes on to say, let's further assume that hedgies need to comply with collateral requirements, as in fund a portion of that unrealised loss, at 40% for their short accounts or short positions. So they need to have a collateral of at least 40% of the short volume or 40% of the unrealised loss, which in this case is around $1.6 billion that they'd have to provide as cash collateral. So the question now is simple. What's the maximum amount of dollars they can possibly provide as collateral? As in, what's the maximum unrealised loss that they can take on before their collateral requirements are exceeded? Well, Citadel, for instance, has a capital requirement of 8%, and with more than $30 billion in managed assets, they have a requirement to hold at least $2.4 billion in cash capital. In other words, they cannot possibly provide more than $2.4 billion for the short account before they get into serious trouble by the creditors and regulators. As in, if their collateral position exceeds $2.4 billion, or 40% of their unrealised loss goes over $2.4 billion, they'll be liquidated. Running the math on that by doing a bit of a find the X equation. Finding the stock price at which would have to be reached for that short position to be liquidated is around an AMC stock price of $70. If you take the $58 loss, multiply it by 100 million shares, multiply it by this 40% capital requirement, gives an unrealised loss that exceeds their capital requirement or their cash requirement of $2.4 billion. And therefore it's no coincidence that hedgies fiercely defended $70 and tried to push us below this point at any cost. We barely passed $70 for a reason, because if the apes push this well above $70, which is not really that far away, hedgies get into serious trouble and will have to start covering their short positions and being liquidated. Now, many of you will say this, it doesn't have to be above $70 necessarily, it would just suffice to hold until they run out of money, because obviously they have to pay a borrowing cost on their short positions. And that's absolutely true. But what the poster is saying is that $70 or the AMC stock price reaching $70 or over might be the point of no return for hedgies, and they would have to pretty much instantly cover. And hedgies are scared because they know they will need to buy back at any price. At any price. Guys, leave a comment down below letting me know what you think is going to happen tomorrow when that failure to deliver cycle ends and they have to cover those failure to deliver positions with the short sale restrictions enacted. If you want to pick up some shares in AMC but you haven't even yet signed up to a trading platform yet, be sure to check out the links down in the description below to get some free shares with very low minimum deposits. $5 with Webull in the US or £1 with free trade in the UK or in Europe. With Webull, you can currently get 2 free shares worth up to $2,300, and they've just reduced their minimum deposit, as I said, to $5. With free trades, you can get a free share worth up to £200, and they've always had a minimum deposit of £1. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.